Hey guys, in this video, we're going to be reviewing a very popular stock. We're going to look at Costco. Costco being one of the top places for people to buy groceries as well as many other home items. And they are a company that's basically been built on a membership-based warehouse style retail format. So a lot of people basically get their membership, which is a big part of their revenue, and then they go get groceries there, they go get things for their home, and they buy in bulk. So because they sell in bulk, they can sell more at a wholesale price. People buy more at a time, and people tend to save money, but they pay the membership fee, which also leads to customers having more loyalty. If they are willing to get a membership somewhere, a lot of times they are loyal to that company. So Costco stock here is one, I have to confess, is one I've been really waiting for a good time to buy Costco. Maybe that time has passed. I don't know. We're going to break down the whole thing here and analyze the stock. But today down 0.35%. If you look over the past 6 months or so, they're down 9%. It's not that great. Year to date, they're up 7.21%. It's positive, but it's not amazing. And then over the past year, up 13.06%. Over the past 5 years, pretty solid, up 190%. And if you compare that to the S&P 500, the S&P 500 is up 5.79% over the past 6 months, up 10% in the year to date, up 18.58% past year, and up 91.78% in the past 5 years. So really the main way they are beating the S&P 500 is over the past 5 years. Again, obviously, past performance doesn't equal future performance, but it is good to at least kind of compare that to an extent. Now, another thing about Costco, you're looking for solid growth from Costco. This is not typically someone or a stock people use for dividends or for retirement or things like that. So the dividend yield is there, but it's very low. It's only 0.5%. So you are getting a very minimal dividend, and you're really hoping to beat the S&P 500 growth here. Now, another thing I like to look at is how have they done over like the past quarter or so in terms of their stock. Obviously, I'm not talking about specifically their business numbers. We will get to that in a second. But over the past 3 months, they are actually down 2.18%. Now, if you look at their guidance and how they actually did in Q2 of 2025, they actually did pretty well, apparently, with an 8% increase in revenue and a 13% rise in earnings per share. They also had a 10.4% increase in membership fee income as well. Now you can see right here on their last earnings call, which was May 2025, they actually beat EPS by 0.86%, not by a whole lot. And they beat revenue by 0.17%, not by a lot either, but they did beat. Now, their financial numbers look pretty good. They're up year over year across the board. Not huge increases like some other stocks I have covered, but you know, this is also a different sector. It's not necessarily a super high growth tech stock. If you look at balance sheet here, assets versus liabilities, I'd like to see that a little bit better. I'd like to see closer to a 2-to-1 ratio or better, but still not terrible. Obviously, that is going up. Price to book doesn't seem like any sort of red flag here at a 16. Return on assets, 5 to 10% is usually pretty good, so they're right in that ballpark. Return on capital is actually pretty solid at 18.31%. Now, another thing to keep in mind, their PE ratio, according to Google Finance, is a 55.33. That's a pretty high PE ratio. Obviously, it depends on the stock. It depends on their growth. Sometimes it's worth it, in my opinion, to buy a stock if the PE ratio is high, if you think they are going to grow significantly over time, and they've proven that they have the business model to do that. But either way, that is typically seen as a high PE ratio. But we're going to also compare that to a few other PE ratio alternatives. Now, you can also look at the PE ratio on Robinhood. So sometimes this is a little different than the one on Google. Apparently Google uses more of a trailing PE ratio while Robinhood uses more of a forward PE ratio. Right now though, they are pretty much the same at around 55. It's also interesting to see what hedge fund managers and insiders are doing. Hedge fund managers, obviously their entire job is to get the best returns for their portfolios and their clients who have trusted them with their money. So hedge funds are actually selling more than they are buying when it comes to Costco right now. They don't have Q2 on here yet, but for Q1, 81% were selling in terms of actual hedge fund transactions. If you look at insiders, they've mostly been selling over the past few months, although you're only talking about 4 informative sells over the past 3 months. Now, in terms of analyst ratings, they have a 53.8% buy score, so just over half of the 39 analysts say it's a buy right now. 43.6% give them a hold score, so very close between buy and hold. 2.6% give them a sell score. Now, if you look at how their estimated earnings versus their actual earnings look, most of the time they barely hit on earnings. They usually do not go that far outside of expectations over time, as you can see by this chart here on Robinhood. Now, another alternative to a PE ratio that I like to look at is the EV to EBITDA, which stands for the enterprise value versus earnings before interest, taxes, depreciation, and amortization. So some companies, as I had to learn the hard way myself investing, is sometimes what they will do is they will use certain tax and accounting strategies to make their earnings look higher than they actually are, than their actual raw earnings. So it can help their PE ratio look better. So therefore, PE ratios are not always the best to look at. Some people don't use them at all. Some people live and die by PE ratios. It's kind of all over the place depending on who you ask, but I think it's just one of many, many indicators that you look at. So I also like to look at the EV to EBITDA because it's more of a raw number. Now this one is actually lower than their PE ratio at 32.92 for Costco. Now if you look at their PEG ratio, this is a little bit scary actually. They have a forecast 12-month forward PEG ratio of a 6.09. So that usually means that they are way overvalued. This is on NASDAQ.com, the official NASDAQ website, so you know it's a trusted source. Now PEG, instead of just a straight up PE ratio where you're going from price to earnings, you're looking at price to earnings growth rate. So if you're looking at the growth rate over time and the price that you're paying for Costco stock, if you put those together, you're looking at a very high PEG ratio. So to put this in perspective, normally a undervalued stock, which is a good buy, would be like around 1 or less. A kind of moderate stock that's kind of between maybe like a hold or a fair value, you're looking at something like a 2, maybe a 1 to 2 in there. And then if you are overvalued, which means usually you're overpaying for a stock, you're over 2. You're well over 2. This is the highest one I've seen since I saw Tesla's recently. Tesla, I also think, had something like a 6 PEG ratio. Those are the 2 highest I've seen this year, I think. So that is a bit concerning. If you look at earnings per share, analysts do project that they will still increase earnings over time. But again, if you look at how much they beat on earnings, typically it's not by much. They actually did miss Q1 2025, and you saw some hedge funds and some insiders selling on that information. So even when they do beat, it's very much by a small margin. But they are projected to still increase sales over time. I also like to see if they are a well-run organization, and one of the best ways I think to check this, again, everybody has their own methods. Some people might want to watch an interview with the CEO and determine it that way. Some hedge fund managers might have connections to CEOs and know them personally. I think it's good to look at what the employees at an organization say about what it's like to work there. How do they feel about the leadership? What is the company culture like? If it's not good, I don't want any part of that company. I don't care how great their idea is. That's just my personal strategy there. So they actually have a pretty good overall score from employees at 3.9 out of 5 stars. They've been nominated as a best place to work many times over the years. If you look at how many employees at Costco recommend working here to a friend, 73% is a very good score. That's about 3/4 or just under of their employees recommending this as an employer. And then a little over 3/4 of employees approve of the CEO. It's also a great score. You need to have a good person in charge as well as a good company culture. So they do have all of that going for them. This is one where it's not like a big tech company. So you're wondering, okay, well, if I'm not getting much of a dividend from Costco, if I'm kind of focused on this being like a kind of a staple type of company, like a consumer staple type of investment, you're looking at, well, what are they going to do? How are they going to drive more growth other than what they're already doing right now? Are they going to do anything that would cause a jump in their stock or a jump in sales? Well, it looks like mostly what they're doing, if you really look into it, is they're just going to open more warehouses. They're going to continue to improve digital offerings, and they are kind of just counting on repeat customers staying with them long term. Doesn't seem like they have a lot of big ideas they're trying to do. Like you see, for instance, Tesla, despite what you may think about them, they're at least taking some moonshots trying to develop self-driving taxis and personal robots. So, they don't have anything like that. They don't have any sort of like big idea seemingly that they are trying to build for the future. It's more just like, well, everybody needs groceries, everybody needs stuff for their home, and we are going to compete with the top grocery stores, Walmart, all these other types of retailers, and provide the bulk pricing, the wholesale pricing that keeps people coming back. So I know I've been giving a lot of hold ratings lately in some of these stock analysis videos. I actually have Costco as a sell right now. Unfortunately, even though it's one I would like to own at some point or I've wanted to own in the past, I just think that right now, I don't know what you're counting on for them to make any sort of big jump. I think that if you look over the last quarter, the last 6 months, you're not seeing much growth. You're looking at, well, can I beat the S&P 500? That's really how I judge this. Would I rather have the S&P 500 or would I rather take the same amount of money and put it in Costco? Which one do I think will perform better? I really think you would be better off just buying the S&P 500. Now, this is not financial advice. I actually don't know your situation. I don't know what your portfolio looks like. There's a lot of things that go into that, like diversity of your portfolio and all of that. But if you are looking for a growth stock, which is what Costco would have to be given their low dividend, I just don't know if you're going to do any better than the S&P 500. So it doesn't look like you will right now unless something really changes drastically, which I don't think it will. I think it's just going to be business as usual. It might be kind of a slow growth. Maybe it might even be considered a safer stock than a lot of obviously tech stocks, which can go really high but also tank quite a bit in one day. But with the low dividend yield, I just don't know if it's worth it right now. If I had it, I don't know if I would keep it. I don't know if it's a good time to buy either. I think the price is actually too high. So I'm waiting for a correction before I would really consider buying Costco.